If you currently own a home and are looking to tap into your home's equity without completing a full on cash out refinance, or if you are looking to purchase a property utilizing creative financing, a HELOC or a home equity line of credit might be a great option. In today's episode, I have on Ed Schwartz, who is an account executive with Symmetry Lending, and we go through some of the products that they currently offer, as well as the scenarios in which those would apply. And if you have any questions at all, feel free to comment below. I'll also have a link in the description of this video in which you can get in contact with me. And if I haven't met you yet, my name is Connor Webb. I am a mortgage loan advisor, a mortgage loan officer here in the Pacific Northwest. I currently am licensed in Washington, Oregon, Idaho, and California, and it's my job to assist my clients in guiding them into whichever mortgage financing option is best for their needs. Again, I'll have that link in the description of this video if you'd like to reach out. And with that, let's get into the podcast. All right, Ed, thanks for joining me on the podcast to talk all things HELOCs. Symmetry Lending, I know that there's various products that you guys offer, specifically with HELOCs. You know, I've used you in the past with various clients, both with standalone HELOCs and also simultaneous close. I just wanted to get into some of the scenarios that someone might use a HELOC and what you guys specialize in and what makes you different from other lenders.
My pleasure. My pleasure. I'm excited to have you on, or for you to have me on, rather.
Basic overview, you know, what is a HELOC and what are some big use cases of why someone would get a HELOC?
Yeah. So a HELOC, the acronym HELOC stands for Home Equity Line of Credit. And the reason why people love HELOCs in general is the amortization is dramatically different than a 30-year fix. So, for example, typically, if you were to go out and you needed to access equity into your property, for example, and you did a 30-year fix, people tend not to pay them down very aggressively for the reason that once you it's a one-way product. Once you pay your money into a 30-year fixed or a 15 or a 20-year fixed, you can't get your money back out. So the reason why people absolutely love HELOCs is you can draw money out, you can use it for a project, and you can pay it 80%, 100% back down and let it sit dormant till your next project comes along. So it's the ultimate in flexibility, and there are absolutely dozens of reasons why people use them. And I'm
Especially
glad.
right now with a majority of people, if you'd owned a home and you have a mortgage on it, you likely had refinanced over the past few years when interest rates were extremely low. Now, if you're looking to tap into additional equity in your property, you likely aren't wanting to do a cash out refinance because you would have to go up to the, you know, pay off your existing loan, go up to the higher interest rate. And so by having a HELOC that allows you to keep that original mortgage with the lower interest rate while also tapping into your home equity, that gives you the wiggle room there. And
Yeah.
so can you walk me through with the HELOC, what are the typical loan terms as far as if you were to get a HELOC on your property? You know, how long is the drop period for? How long
Yeah.
is the typical repayment period?
Yeah. So it varies from lender to lender. There are some HELOCs in which there's a 3-year draw. I've seen them as long as a 10-year draw. And then our particular product is a 5-year draw. So what that means is for the first 5 years, you can draw it up as many times as you like and you can pay it down. After the end of 5 years, then it goes into an amortization. Let's just say you start off with a $100,000 line, and at the end of 5 years, you've paid all of it down except for 20,000. So at the end of 5 years, you would have to, over a 25-year period, pay down the remaining 20,000. And it gets amortized. You can't pull the money back out. So that's the way that it's set up. My experience, HELOCs don't stay on the books as long as 30-year fixed do. You know, typically projects get finished up, they get paid down. They tend not to stay on the books, and they tend not to get into the amortization period as much as one would think. But that is what happens at the end of the draw period.
So now if you're in the draw period and you were to pay down that entire balance, let's say it's a 5-year draw period, that
Mhm.
draw period doesn't restart if you pay off the balance, or does it?
It does not. It does not.
Okay.
So it's 5 years from the time when you very first fund. That's when the clock starts ticking.
Mhm.
So
So then you'd have to get reapproved if you wanted to extend that drop period and get into that again.
absolutely. Yep.
So there's the standalone where you currently own a property, you already have a first mortgage, and then you're looking to get a HELOC to tap into current home equity. Can you walk me through the typical simultaneous close and why someone might look to get a HELOC while they're also purchasing that same property?
Yeah. So there's a number of reasons. Probably one of the more prevalent reasons is for people to avoid a jumbo loan. Connor, I'm sure you have seen there's a big difference between conforming, meaning Fannie Mae, Freddie Mac underwriting and jumbo underwriting. And there's a million reasons why a loan will get kicked out of going through a jumbo loan. So maybe it's because of pricing, but people like to split up loans. They'll do a first for the maximum loan amount that you can do. What is the maximum loan amount, Connor?
Now it's up into the 760s, I believe.
760. Okay. So they'll do the first for 760 and then maybe they'll borrow another 100,000 or another 50,000 or another 3 or 400,000 to avoid doing a jumbo loan. Frequently jumbo investors won't they're a little bit pickier on properties. They have got a few more reserve requirements than say Fannie Mae they'll require a self-employed borrower to show 2 years of tax returns, whereas Fannie Mae will allow one and will mimic Fannie Mae. That's one reason. So another reason why people might use a home equity line of credit is let's just say, you know, as you know, Connor, there's very few contingent offers that hold up. If you're in competition with somebody who is maybe writing out an offer for even less than you, but it's a non-contingent offer and your offer is contingent, the offer is probably not going to fly. So a lot of times people might have a couple $100,000 of equity in their departing residence and they'll want to purchase the new property without having a contingent offer. So they'll do a line of credit on the new home that they're buying for a couple $100,000. And then when their old home sells, then they can pay down or pay off their home equity line of credit. So it's a way to avoid very what tends to be very expensive bridge loans. People like to avoid bridge loans. They also like to avoid contingent offers because competition in the marketplace can be fierce, especially if it's a product, a home that you're purchasing that you absolutely love. There's going to be, there could be a dozen people writing offers on that, and you want to come in with everything you got.
Yeah. Yeah, you mentioned avoiding jumbo. You mentioned avoiding the bridge loan. There's also the 80-10-10 to where you're trying to avoid the private mortgage insurance. So instead of coming in with 20% down out of pocket, you can bring in the 10% down, have a 10% HELOC, and then those combine for the 20% down to avoid the private mortgage insurance.
Absolutely. Yeah. While many people dream about owning a home, nobody ever dreams about having private mortgage insurance, which does the borrower absolutely no good. And again, if you've got a home equity line of credit, people tend to pay these down more aggressively because you can get your money back out. So there's a lot of people that will look to pay down their home equity line of credit over just a year or two. Whereas mortgage insurance can stay on your home for a long time and cost you a lot more money in the long run.
Yeah. So let's say someone wants to team up with us and they're looking to get a HELOC done. How long does that typical process take if they currently own a property and they're looking to just get a HELOC on their current property?
Yeah. I usually tell people to budget about 2.5 weeks from the time that they apply with you, from the time we get the loan till the time that they sign. And then there's also, if it's a standalone, meaning it's on their existing home, not on a purchase, there's a right of rescission. So there's also a 3-day right of rescission. So they probably ought to budget about 3 weeks until they actually have money sitting into their account. Can get it done quicker, but the thing that we have a little bit of a delay on when people are applying for a home equity line of credit is we have to wait for the appraisal to come back.
And then minimum qualifications, talking about generalities, what are the typical, credit score requirement? What's the maximum, value of the HELOC plus the first mortgage that you can go up to compared to the value of the property?
Yeah. So we can go up to 90% or 89.99% of the total value of the property. And we can go up to a $500,000 up to 89.9. We can go up to 750,000 up to 80%, which I think is on a little bit on the high side for what I see out there. And there's probably I'm guessing there's probably places that accept lower credit scores. Our minimum credit score is 700 for a standalone product. And then for a piggyback, we go a little bit lower, 680. And as I said, I think there's probably lenders out there that go a little bit lower. We tend to have a very clear box that we underwrite in. The result of that is if you do qualify, it tends to just slide through the system and be a very pleasant, easy process.
And then what are the differences on getting a HELOC for a primary residence compared to a second home or an investment property?
Yeah. Yeah, so on second homes and investment properties, the main difference is that lenders have typically have higher rates. We actually don't have higher rates for second home or investments, but typically lenders will have higher rates for them. The underwriting requirements are a little bit more stringent, like the debt to income, the amount that you're spending on housing and debt is a little tiny bit less for an investment or a second home. And then also on second homes, we will only go up to 80%, on investment properties up to 70%. So again, the amount of equity that has to stay in the property, there's a little bit more risk from second home and investment properties. Historically, investors have had have had people walk away from, when markets go bad, walk away from investment properties a little bit more. Whereas the experience is people who have a primary home will do everything they can to hold on to that, even if they lose their job, even if something bad happens. People tend to do everything they can within their power to make those payments. Whereas from an investor standpoint, investment properties and second homes, not so much.
Right. And then just to have someone else other than me say it, I've had some scenarios come up in the past where, someone currently lives in a property, they're wanting to buy an investment property or move to another property as a primary,
Yeah.
but they want to get a HELOC on their current. So what time frame would they have to hold onto that HELOC or stay in their current primary residence in order to qualify for a primary residence HELOC before moving to another property?
Right. Yeah. So again, this varies from lender to lender. So I'll just speak from our position, which is when a person applies for a loan with us, we just ask that it be their intention to own or occupy the property. Things do change. So sometimes it could be a month later the person finds their dream home. It happens. So there's no set time frame. There's no we don't come after the borrowers if things change. We just ask that it be their intention when they take out the home equity that be their owner occupied home. What that means is they cannot have listed the property.
Mhm.
And it also means that they can't be in contract to buy a new owner occupied property at that time.
Gotcha. Yeah, thank you for the clarification. Yeah, that makes a lot of sense, and that's definitely a common scenario that comes up. Any other big things to talk about or mention as a part of the HELOCs and some of the programs that you guys have available?
Yeah. So a few things just to make you aware of. These are things that I don't think people think about a whole lot. But one of the uses of HELOCs, especially with so many first mortgages down at 2 3/4 and 3%, is you
Mhm.
have people looking to buy homes that have assumable loans. So maybe it's a VA, maybe it's an FHA loan. So one of the things that we can do is let's just say that the VA was done, and since that person purchased the property, it's appreciated by a couple $100,000. So the purchaser could assume the first mortgage at 2 3/4 or wherever it might be, and then come up with the balance of the down payment through us. So that's one reason why people might use our product.
That's a great scenario that's come up often. People asking, "Hey, I want to assume this loan. Is that possible?" Well, you have to bring in the difference for cash, right, to make the purchase work. But if you could just get a HELOC, then you don't need all of that out of pocket. You get a HELOC, pay that back over time. That makes a lot of sense.
Yeah, and VA just issued I think they call it, they put out a circular stating that second mortgages are okay for down payment, was the way I interpreted it. So there were some servicers that were okay, some that were not. I'm guessing that all VA servicers should be fine based on this last ruling. So that's one thing. Just another couple things to point out to you. And Connor, I know this is your specialty. A good loan officer is always looking. It's funny. People, I'm sure, will call you and they'll be like, Connor, rate, 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 rate. What's your rate? What's your rate? What's your rate? And but what they forget about is that a really awesome loan officer, such as yourself, takes it to the next level. So, for example, somebody buying a second home right now, if you were to purchase, Fannie Mae came out and issued, they basically don't want too high of a percentage of home purchases to be either investment property or second home. So right now, if you buy a second home and you're looking to put down, say, just 85%, you know that the loan level price adjustments are well over 4%. So somebody's going to have to dig very, very deeply into their, I think by the time you add up all the loan level price adjustments, it's over 5 points. So one of the things that you can do is you could do say a 60% first and a 25% second, and you can save that person, well, just on an average size second home, you can save them over $10,000 in closing costs just by doing a 60-25 or a 60-20 instead of an 80%. So loan level price adjustments, magical, just by structuring the loan differently. Another thing, again, getting back to loan level price adjustments, we're going to start to see more and more people looking to do cash out refinances. And if you look at the loan level price adjustments on an 80% cash out, what, Connor, you know that it's not cheap.
Hmm.
So again, if you just do a 60-20. I just did one a few weeks ago I helped a lender structure it, and on a $400,000 total loan amount that they were using to pay off a ton of debt, we were able to save them over $10,000 in loan level price adjustments. Just dramatic. And again, this is where your expertise comes in. So just structuring things a little bit differently. Yeah, and again, that's why people come to you. That's why people don't use the junior loan officer, maybe at a credit union, who is just out of college. That's why they come to a guy like you who is more of a consultant than a salesperson, somebody who knows how to structure things differently.
Yeah, those are massive differences. You mentioned saving potentially tens of thousands of dollars just on the closing cost itself of doing the loan. Creative financing makes a huge difference. I guess one other question that we didn't cover already are the interest rates. So, not specific interest rates today, but in general with HELOCs, it's
Mhm.
typically on a variable interest rate, if I'm correct. And how often do those interest rates adjust, and how often can you see, those things fluctuate and change?
Right. They're connected to prime.
Hmm.
I think anybody can pull up the history of Prime. It's the Wall Street Journal Prime. So you can literally just click on a link and you can see historically what Prime has done. So Prime has come up, we were down very, 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 very low for probably 4 or 5 years. And then the last 3 years, Prime has shot up again. Prime is recently trending downward. We've just had one major rate cut, but all HELOCs are based on prime plus a margin. So our very best pricing for somebody who's doing a piggyback might be prime plus zero. With our program, the very worst pricing for somebody who has lower credit score and higher loan to value might be prime plus three, three and a quarter, in that range. So that's the range that I'm seeing. But again, for me, I don't think it's ironic that I do this for a living, that I represent a company that does HELOCs, because I have used HELOCs myself to purchase investment properties, to redo properties, to build ADUs. I've used it for so many opportunities. Conversely, when the company that I worked for went out of business, I've used it to keep myself afloat. And that's the main thing that when I think about a HELOC, I don't get as concerned about rate as I do, what's it going to do for me? I used it one
Right.
time, back when I lived in Chicago, I got a 13.5% home equity line of credit, which was astronomical. But the condo conversion that I did, I made, over $100,000 on the thing. So I think for a lot of people, it doesn't matter so much the rates as far as what do you do with it. And that's the beauty of a home equity line of credit is there are so many applications for you to not pay so much interest on credit cards, for you to have the opportunity to buy your next investment property, your next second home, your next owner occupied. So there's just a ton of uses ranging from, again, so many things that we've already covered.
Yeah, and just the flexibility that a HELOC gives you,
Yeah.
as you mentioned, yeah, the interest rate doesn't matter as much on something like this because it's the flexibility that it does give you. But throughout the draw period, the interest rate is trending off of that prime rate, and then at the repayment period, is that when it's locked in to where it's steady for the next X amount of years?
Again, it varies from lender to lender. With us, it does get locked in for a year. However, it will still reset once a year based on
Okay,
prime plus margin.
okay,
So,
once a year.
yeah, the only thing that will change is the amount that you currently owe and the number of years that is left till, as the amortization period goes forward. The first year 25, the second year 24, and on down.
Perfect. Awesome. Well, Ed, really appreciate your time and the insights on some of the programs that you have and behind the scenes with HELOCs. Looking forward to working together in the future. And if you have any questions, feel free to reach out to either of us, and we'd be happy to help.
Always a pleasure talking to you and working with you. Thank you, Connor.